Hi, Assalamualaikum. My name is Muhammad Razi bin Osman. Today, I'm gonna presenting about risk-based financial ratio, especially for Bank Islam market risk. Okay, so we go to the first part, which is introduction. Risk-based financial ratio are simple tools that help us to understand how much the financial risk a company is taking and how well it can handle based on the situation like manage the debt or cash. Instead of just looking at the profit, this ratio are focused on things like how much the debt a um, company has, whether it can pay its bills on time, and if it has enough backup funds to stay safe during the difficult situation. And they are especially useful for bank and business that want to stay stable and avoid the difficult situation. And then definition of market risk refer to the possibility of loss in Bank Islam financial assets or earning due to the movement in market price. There, this include the interest rate risk, which change in the profit rates, or we call Islamic alternative rates. Foreign exchange risk refer to the risk fluctuation in currency value, and then the equity risk where the risk from change in stock or suku price we call Islamic bonds, and commodity risk exposure to change in commodity price, which less common for Bank Islam. Relevant if involved in commodity link transaction like link the transaction like the what we call the tower contract. And then so market is a potential for loss due to fluctuation in the market, like market variable like interest rate, foreign exchange rates, or equity price. A common ratio to manage the market risk, which is the value at risk. Okay, so because we focus on the value at risk is widely used to risk manage tools that quantify the potential loss in value of a portfolio under the normal market conditions over a set time period at a given confidence level. Okay, so for a bank like managed bank Islam, value at risk or VAR serves crucial tools in managing financial risk exposure. VAR enables the banks quantify the level of market risk inherent in its trading book, which may include investment in equities or suku in foreign exchange position by estimating the potential loss under normal market condition over a specified time horizon and also the confidence level. Bank Islam can make informed decision about how much the risk it is exposed to at any given time. This risk quantification is essential for effective capital allocations, allowing Bank Islam to set aside its sufficient capital reserve to absorb the potential loss, ensure financial stability and soundness. Additionally, VAR plays the role in supporting Bank Islam compliance with regulatory framework such as we know Basel III, which basically require banks to maintain adequate capital buffer based on their risk exposure, and it help enforce internal risk limited limits sorry internal risk limit by providing a standardized measure that can be used to monitor and control trading and investment activity within acceptable risk threshold. So next, okay, this is the formula for VAR, the basic formula, which is position value uh, times the volatility times the Z score, and the simple explanation about VAR formula, which is a position value refer to the total market value of the asset portfolio. Um, Volatility, which is a standard deviation of asset returns, usually annualized but convert depending on the time horizon. And then Z score is corresponding to the confidence level. So let's assume Bank Islam hold a fixed income portfolio worth 200 million ringgit with a daily volatility of 0.4%, and Bank Islam use 99 confidence level, which Z score is 2 ringgit 2 ringgit and 33 cents. Okay, and after we compute uh, the VAR for Bank Islam, and I got 1.864 million ringgit. So the interpretation of VAR with a 99% of confidence, BNB can expect that on any given day, the portfolio not lose more than 1.864 million, um, based on the normal market condition. This means there are 1% chance that loss could exceed this amount. So, alright, so for the application in framework, Bank Islam risk management framework, the value at risk is actively applied by the Treasury and Risk Management Division, which monitor in on a daily basis to ensure the bank exposure to market risk remain within the acceptable level. So this instrument establish the risk limits for individual trader or trading desk. Also to help control helping to control excessive risk taking and align trading activities with the bank overall risk appetite. And additionally, VAR function as an early warning system, signaling when a potential loss are approaching or breaching a defined threshold, which allow for timely intervention and mitigation. So to ensure the accuracy and reliability of the VR model, Mixlam perform a back testing, comparing the model predict loss with actual outcome to validate its effectiveness. Importantly, in the context of Islamic finance, VAR in support the compliance by providing a structured and ethical approach to risk assessment. They avoid speculation of gharar and ensure investment remain within the Sharia compliant boundaries. Wait, okay. So for the next, which is the limitation of VAR. So VAR typically, sorry, assume a normal distribution of return which may not accurately reflect a real world market behavior, especially during the extreme event. As a result, it fails to account for forfeit tails or but several losses, often referred to as a black swan events. This make a VAR an incomplete measure in times of financial crisis or market turbulence. Additionally, VAR is not a worst case scenario tool and it only estimates potential loss under normal market condition at a given confidence level, meaning the actual loss can exceed the VAR estimate in exceptional case. Moreover, VAR does not capture liquidity risk, which refers to the difficulty of selling assets quickly without significant price impact. Nor does it directly not address model risk, which arise from incorrect assumption or limitation in the VAR model itself. VAR model itself. This shortcoming mean that while VAR is helpful tools, it must be complemented with other risk management technique to provide a more comprehensive view of risk exposure.